Hello everyone. Welcome back. Today is the third day of our practice to pass session. So I have concluded another question with respect to the first section of our paper, the consolidated section. This question is specifically related to the acquisition of a foreign subsidiary and its disposal and its accounting aspects related to all the foreign exchange gain losses that might arises on a foreign exchange on a foreign subsidiary. In this section, most of the time we'll be looking into in this question we'll be reviewing two main standards, that was IAS 21 and IFRS 10, along with IFRS 12, the disclosures required for the consolidated financial statement. So let's read out the basic requirements of this question. Then we'll be looking into what aspects should we need to account for, or what are the main portions of our scenario that should be accounted for. So the very first requirement of this question is, what is meant by entities, presentation and functional currency? Explain your answer with reference to how the presentation and functional currency of Bakelite should be determined. So there is a company whose foreign functional currency we need to ascertain using the information available within the scenario, but we have to look into the main aspects of IAS 21, how IAS 21 accounts for what are the main understanding, or what are the main criteria provided by IAS 21 with respect to we'll be looking into the main aspects of our functional currency to make sure that how the functional currency should be accounted for. The second question is the second part of this question is the requirement over here. If you can look into it, you need to prepare an explanatory note for the directors to ascertain to address the following issues. The first issue was how functional and presentation currency should be ascertained for a subsidiary. Goodwill calculation was required on acquisition of Bakelite, and what the balance would be on 30th September 2006, immediately before the disposal of the shares. Your answer should include a calculation of exchange differences on goodwill for the period from 1st of January 2006 to 30th September 2006. So this is the basic requirement, how those foreign exchange gain losses on the calculation of goodwill should impact the subsidiary. Then an explanation of your calculation of goodwill, how the goodwill have been calculated in above these two sections, in this section, and how you're going to account for that goodwill within the consolidated financial statement. You do not need to discuss how the disposal will affect the exchange differences. So these 4 marks are allocated for the impact, for the calculation, and its explanation how the foreign exchange gain losses on the goodwill that arises for the time period of 30th September or during the acquisition period of a subsidiary should be accounted for. Note, you need any working can either be shown in a main body of the explanatory notes or in appendix to the explanatory notes. So any portion you can explain those notes. Section B requires explain why exchange differences will arise on the net assets and profit or loss of Bakelite each year and how they would be presented within the consolidated financial statements. Your answer should include a calculation of the exchange differences which would arise on the translation of Bakelite excluding goodwill in the year ended 31st December 2006. You can see here in this section the examiner has excluded the goodwill calculation because that was already asked within the section A of your question, 2 and 3rd part of the section A. This third requirement is calculate the group profit or loss on disposal of Bakelite. What was the gain or loss that should be arising on disposal of that company, and briefly explain how Bakelite should be treated and presented in consolidated financial statements of Carbice for the year ended 31st December. So they are basically, all these requirements are related to the foreign exchange gain losses that might arise on a foreign subsidiary. So in this section we will be accounting for. Let's move back to the scenario that we'll be looking into it. So the scenario, the background mentioned in the scenario is Carbise is a parent company of an international group which has a presentation and functional currency of the dollar. There is a company Carbise that has a functional and presentation currency of dollar. The group operates within the manufacturing sector. On 1st of January 2002, Carbise acquired 80% of the equity share capital of Bakelite. This subsidiary was acquired by the Carbise company, the Bakelite company, and 80% of the equity portion or equity share of Bakelite was acquired, which is a overseas subsidiary. Now, it's not the subsidiary which is working within the section within the primary economic environment as the parent does, but it is an overseas subsidiary. Now, why the subsidiary was acquired in this way? So this subsidiary, the acquisition enabled Carbise to access new international markets. The main aim of Carbise to acquire Bakelite is to access to the new international markets. Carbise transfers surplus work in progress to Bakelite, which is then completed and sold in various locations. So the main aim of acquisition of the Bakelite, the subsidiary, a foreign subsidiary, was mainly to transfer the surplus work which was in progress to the subsidiary company, the Bakelite, and the Bakelite then complete the remaining work on that inventory, and then the Bakelite is going to sold out that inventory into the new various locations. The acquisition was not successful. The acquisition of this Carbise, the Bakelite, was not very successful as anticipated. What was thought by the parent company, and on 30th September 2006, Carbise disposed of all its holding in the Bakelite. The subsidiary was acquired on 1st of January 2002, and it was disposed of on 30th September 2006. It means around 3 years or 4 years round is the time period for which the subsidiary was within the group structure. The current year end is 31st December 2006. So this is the year end of the parent company. Now we're looking into Bakelite trading information. Bakelite is based overseas, where the domestic currency is dinar. The area, the primary economic environment where the Bakelite was operating right now, as the domestic currency has a primary currency which is dinar, not the dollar. So staff cost and overhead expenses are all paid in dinars. However, Bakelite also have a range of transactions in a number of other currencies. Approximately 40% of its raw material purchased are in dinars and 50% in yen. So 40% of the raw material that was purchased was in dinars, and rest 50% was in yen. The remaining 10% are in dollars, which is approximately half, of which approximately half were purchased materials from Carbise, the parent company. So just this 10%, remaining only 10%, or you can say the 5% of the raw material, was purchased from the parent company. This ratio continued even after Carbise disposed of its shares in Bakelite. Revenue is invoiced in equal proportion between dinars, yen, and dollars. To protect itself from exchange rate differences, Bakelite retained cash in all three currencies. No dividend have been paid by Bakelite for several years. At the start of 2006, Bakelite sought additional debt finance as Carbise was already looking to divest. Funds were raised from an issue of bonds in dinar, none of which was acquired by Carbise. Next thing is the next portion, or the next scenario, is about how the Bakelite was acquired. Carbise paid dinar 100 million for 80% of the ordinary share capital of Bakelite on 1st January 2002. The net asset of Bakelite at this date had a carrying amount of dinar 60 million. The fair value adjustment deemed necessary was in relation to the building, which had a fair value of 20 million dinars above its carrying amount and the remaining useful life of 20 years at the acquisition date. So there is one fair value adjustment with respect to a building, and the fair value adjustment was 20 million dinars, and the remaining useful life of that building was 20 years. Carby's Mayer's non-controlling interest at the fair value for all acquisitions, and the fair value of 20% interest was estimated to be 22 million dinars at acquisition. So NCA was also held at fair value, so it means there's a full goodwill method, and the fair value of NCI at that acquisition date was 22 million dinar. Due to the relatively poor performance of the backlight, it was decided to impair goodwill by 6 million dinars by the year ended 31st December 2006. The goodwill of a backlight was decided to impair by 6 million dinars. So first we need to calculate what was the goodwill of backlight at the acquisition date, and then we need to find out what was the goodwill at the start of the year in 31st December, 1st of January 2005. Exchange rates between dollar and dinar are given as follows. On 1st of January 2002, the exchange rate was $1 equal 0.5 dinars. Average rate for the year ended 31st December 2005 was $1 equals 0.4 dinars, and 31st December for the same, in the same way, along with 30th September, the exchange rate was given. An average rate for 9 months period 30th September 2006 was given. Disposal of backlight was also provided in this question. Carby sold its entire equity shareholdings in backlight on 30th September 2006 for 150 million. Further details relating to the disposal are as follows. Carrying amount of backlight net assets at 1st January 2006 were 48 million dinars, and backlight loss for the year ended 31st December 2006 was 8 million dinars, right? Cumulative exchange gain losses on backlight on 1st of January 2006 were given as 74.1 billion, and non-controlling interest in backlight on 1st January 2012 47.8 million. So this is the whole scenario. In the whole scenario, I would be looking into IAS 21, the main requirements. So if you're looking into the very first requirement of this question, which was how a presentation and how a functional currency, presentation and functional currency of backlight should be determined, how we can determine the presentation and functional currency of a subsidiary which was acquired on 1st of January 2002. So for that matter, we need to apply IAS 21 implication. So I'll be looking into IAS 21 applications in this question, and first I'll understand what standard explains and how we are going to identify what is the functional currency and how it should be identified. So the functional currency and a presentation currency, IAS 21 provide a complete throughout guideline how you can identify the functional currency of any company. So the functional currency in this case, am I not audible? You actually have the right handouts for the lectures. If you can see here, there are two notes available. One, this question 1, and you have this question 2 available within the same document. You can see here, this is question number 1, and once you have completed, or you can move to the page 7 of this document which was shared with you, which is question number 1, right? So this background was provided within this document, I believe. Yes. And the second one was we were discussing yesterday about the accounting implications or impact of COVID-19 on accounting. So I have downloaded a document and I have reviewed it. There are a lot many items those are mentioned within this document, and this document is specific to the Pakistan jurisdiction, but I'm quite hopeful that only one item, that was a financial reporting relaxation allowed by the Securities Exchange Commission of Pakistan, was the only differentiation. For the rest of the individuals who are not within the Pakistan, so rest of the students can ignore this impact on, or we can say every student can ignore this one impact, the financial reporting relaxation allowed by SECP. Rest all the adjustments related to the accounting standard were applicable to all the individuals. I hope now this makes sense. The first document was related to the COVID-19 applications. I don't want you guys to go through the whole documents or to learn those important implications provided within this document, to learn those by heart. You only need to make sure that you are understanding the idea what the COVID-19 has an impact on the accounting standards. So there are many standards, those are mentioned, and an explanation provided on the same document. There's 18-page document, so you'll be going through the whole items. If we got time at the end of this class today, I'll be discussing those within more detail. So I'll be looking into the question section after some time. So yes, it is possible. It is possible that COVID-19 implication will be implied in the paper, and for your information, it might be tested for your knowledge. It might be tested in current issues section. So that's one of the important aspects. Okay, I hope this is now handouts and all those sections are pretty much clear. And there is one more question: if there are multiple subsidiaries, more than one subsidiary, and including one foreign subsidiary, how we are going to account it for? I'll be going to explain it, how we are looking into the multiple subsidiaries having one overseas subsidiaries and how we're going to consolidate it. I'm going to explain this one within this same section. So first thing comes first, we need to look into the functional currency. So what is functional currency? IAS 21 explains the functional currency of any company can be considered to be as the primary economic environment currency of for the entity, right? Most importantly, this, while identifying a functional currency, identify the primary economic environment for the entity, and the currency of primary economic environment is the functional currency of that company. Now there comes another issue. If there is a local company which is working in just only one jurisdiction, so company is not supposed to make its sales in different currencies, and company is not required to get services and items, raw materials in different currencies. The company is using the same primary economic environment currency to purchase its raw material, and it's paying all its employees and for rest of the services it's obtaining within the same currency, like electricity usage and all other commodities uses would be paid in the same currency. So if it is a local currency, that's not a big deal to find out what is the functional currency. But as far as in this scenario, we're looking into the question, it's a backlight company which is operating in multiple jurisdictions. It's not working in just only one territory, in one economic environment. It's working in multiple economic environment, and the company is making sales in multiple different countries, multiple economic environment jurisdictions. So here comes, if there is a multinational company, so IAS 21 provide you certain guidelines. You must have to look into the primary factors. What are those primary factors? Based on those primary factors, you can identify what is the functional currency of the company. So it's very important to identify what is the functional currency. So any transaction once was done by the company should be translated into functional currency, and then it can only be recorded into books of accounts. Before translation, it can never be recorded. So we're looking into the primary factor. The first primary factor is currency in which the entity decide selling price of its products. What is the main currency in which the company itself decided what is the selling price of its products for selling those products across the globe or across all the economic environments within which the company is going to operate, right? Second criteria was mentioned as, if you are not able to identify, or if you're not able to find out what was the selling price for your products and in which currency you are deciding the selling price of your products, then you will be you will be identifying the selling price of your products based on the competitor forces, the competitors who are making the selling price. So in most of the cases, company might not be able to ascertain its own selling price because the company don't have a hold in the market. It has not much good reputation within the market. So it is possible that company is going to set its prices based on the prices made by the competitors, right? So in this case, if the company is not able to decide what is the selling price of its products in any of the currency, while company is deciding its selling prices for different jurisdictions, for different primary economic environments, based on the selling price of its main competitors within that economic environment. So the selling price, so the functional currency of the company would be based on the currency in which the entity is forced to decide its selling prices of its products by competitive forces. If you're not able to find out what is the currency of competitive forces in which the competitive forces are assigning a price to their products, then there is a third primary factor you need to identify, which was currency in which entity paid its cost, including its main cost, its direct cost most of the time, which is labor cost, material cost, and other costs incurred in providing goods and services. Right? So these are the three primary factors you need to identify. And we're going to apply all of these primary factors to our scenario and to ensure or to make sure that whether these primary factors are applicable to this scenario or not. Second, if these primary factors are inconclusive and you're not able to find out, or you're not able to ascertain what was the primary currency, what was the functional currency of the company, then you need to move on to the secondary factors. What are secondary factors? The first secondary factor is currency in which company has been mainly financed, in which currency the company received the finance, including both loan and the share capital. Right? These are the two sources of finance for the company. Second secondary factor is currency if you're not able to identify. For example, company has obtained loan, and company has obtained, suppose, 3 loans. One is in dollars, one is in yen, and other loan is in dinars. So we cannot identify which one is the most important factor in which the company has actually get the finance. The next secondary factor is currency in which the entity retains its recipients from the operations. Right? So these are the two secondary factors that we need to identify, and if we are not able to identify, like in case of Bakelite, we might not be able to explicitly ensure ourselves that this is the primary or a secondary factor that was 100% fulfilled by the Bakelite to make us conclude that this is the primary currency of the company. Then in that case, you need to make sure majority of these factors should be satisfied for one of the single currency, and you are going to consider that specific currency as the functional currency of that company. Before moving on, I would say, so this is role of functional currency, we'll be looking into role of functional currency in later stages. We need to find out if the functional currency was identified. Within this case, it's fine. But if it is a subsidiary, if there is a subsidiary company, there is a one parent company, so you need to ascertain how much control the parent has over the subsidiary company. So you can assign the parent's company's functional currency as the functional currency of subsidiary, depending upon the situation, how much control parent can exercise on the subsidiary or on the foreign operations. If the foreign operations are not autonomous in nature, they don't have the autonomy in it, and they were not able, the foreign operation, or in this case the Bakelite is not able to make its own decisions, Bakelite is not able to retain its profits, and Bakelite is required to reimburse all the profits back to the parent. So these are the indicators which shows that the parent company has a very strong impact on the subsidiary, and subsidiary is no more a separate operation, it's just an extension of the parent operations. So that's why only in that case you can assign the parent functional currency as the subsidiary's functional currency. I believe that that's something I have in consolidated foreign currencies, forex on consolidation. In this section might be, if I have, then I'll be explaining that to you. Yep, this is principal consolidation. This is the principle of consolidation. So I think I have not mentioned. So this is the only case when a subsidiary having different functional currency in comparison to the parent, such subsidiary is known as a foreign subsidiary. So if there is a foreign subsidiary, how we're going to account it for? First, I'll be giving you an explanation. You have to consolidate a foreign subsidiary within the group financial statement, how you are going to account for multiple multiple subsidiaries? That would be something I'll going to answer after the end of this question. But right now we're looking into a subsidiary having different functional currency in comparison to the parent company. Such subsidiary is known as a foreign subsidiary, and we need to make sure how to consolidate it. We are looking into the principles later on. Right now, as we have discussed IAS 21, so we'll be looking into our scenario whether this backlight foreign currency, this is the first requirement, whether the backlight functional currency and presentation currency would be the same as its parent's currency or it's something different. So first things come first, whether the Carbise has a strong hold on the subsidiary company. From this scenario, I'm quite sure if you're looking into this trading information, you'll find out that Carbise don't have a strong hold on backlight. So backlight is most of time an autonomous body. So how we can identify? We can say that first we'll be looking into the primary factors of primary factors. Those are impacting the currency of backlight. So if you're saying it that the backlight is an overseas subsidiary which has a domestic currency of dinar, so the primary economic environment currency of backlight, the foreign subsidiary, is dinar. This is the first factor. But important thing is this backlight is not working within that domestic, within that domestic country, within its domestic jurisdiction. The company is selling its products to in different, like it has range of transaction number of other currencies, and it's selling its product to other countries where it can charge or it can sell its items. Selling price would be charged to different customers in a different way. For example, 40% of the selling was done in dinars, 50% of the selling were made in yen, and 10% of the selling was made in dollars. So based on the first primary factor, we are not able to find out whether the primary currency or the main currency in which the selling price was decided is not completely visible to us in this scenario. So we need to ignore this one, and we can show that the yen is the more important currency in this scenario, which shows that the company might have a functional currency which could be considered as yen. But if you're looking into the next aspect, if I'm going to look into the next portion of IAS 21, which was the currency in which entity is forced to decide the selling prices of its product by competitive forces. Do you think anything was mentioned in this scenario? If we can read it once again, if you want to, we can read it once again. There is nothing mentioned that backlight was forced by its competitors to set its selling prices, right? So in this case, this portion we can completely ignore it, that backlight was not forced by any of its competitor, as it is not clear from the scenario that even it was anywhere forced to decide its selling prices based on or forced by the competitors to decide its selling prices. So that's not the case at all in this situation. The third primary factor is currency in which the entity paid its cost, including labor, material, other costs, including in providing the services. So that's something I believe provided within the scenario. The ratio maintained even after Carbise disposed of its shares in backlight. So irrespective whether Carbise hold the company, hold the backlight or not, the backlight has its own decision to charge the selling price to different customers. As you can see here, even after the disposal of this backlight by Carbise, the backlight even has maintained the same ratio of its sales revenue which it was making before the disposal by the Carbise. So revenue is invoiced in equal proportion between dollars, yen, and dinars. To protect itself from foreign exchange rates, backlight, I believe there is one more thing. This is the cost that was associated. Staff costs and overhead expenses are all paid in dinars. So you can easily mention that the staff cost was already paid in dinars, while that was raw material, which was unfortunately mistakenly liquid into which is considered to be as the selling price. Selling ratio was this one. The company has made the sales in different currencies in equal proportion before and after the sale by Carbise. So company has paid all the staff cost within dinars. That's one criteria that is meeting, while company is paying for its raw material in different currencies, which is one of the major costs. Like company is paying 40% for the raw material in dinars, 50% in yen, and for 10% in dollars. So there is another conflict for the last indicator, the primary indicator. So it means from the primary factors, we might not be able to identify what was the functional currency of the company, because there is a confusion. Company is not, we cannot identify what was the main currency in which the company is deciding its selling prices, because company is selling its products in different currencies like in dinar, yen, and dollars, right? And there is no indication provided within the scenario that company is setting its price in dinars, and then whenever the exchange rate fluctuates, the prices of the products those were sold in dinars and can also fluctuate. If that is the case, then it is pretty much clear that the primary factor of identifying in which currency the company has decided the price of its product is very much clear. But in this situation or a scenario, it's not at all clear what is the main currency in which the company has decided its selling prices. Only information available to us in this scenario is company is selling its products in 3 different currencies in equal proportion, in equal ratio. Right? So primary factors are as inconclusive. So we're looking into the secondary factor. The first factor is currency in which company was mainly financed. Now, if you're looking into this factor, this one section, at the start of the 2006, Backlight sought additional debt finance. The company needs an additional debt finance, the Carbide, the foreign subsidiary, and the Backlight, and the company has issued how many loan? If there is any loan amount provided, revenue is equal by invoice. Backlight retains all in cash in 3 currencies. No return has been several years, and as Carbise was already looking to divest, funds raised from issue of bonds in dinar. Yeah, this is the information which is given. So Backlight issued debt instruments, debt finance, some debt instruments to third parties. Out of these debt instruments, none was purchased by Carbise, and all the finance raised by Backlight was in dinars. You can see here, and the funds raised from an issue of bonds is in dinars. So finance was mainly raised in dinars. That's one clarification that we have received. None of which was acquired by Carbise. Why Carbise have not required any of it? Because Carbise was already looking into divestment. The Carbise was thinking of to dispose of this subsidiary, right? Here another implication comes in. It could be possible that we might be putting Backlight disposal or discontinued operation, right? The company has, the parent always had an intention to dispose of this subsidiary, and subsidiary is a separate business unit based on a geographical location and based on the number of items or the products sold by that subsidiary are very different compared to the Carbide. So we can easily understood that this is autonomous operation, and this is a separate group of units, a cash generating unit, which can be disposed of or which can be considered as discontinued operation. So you can apply IFRS 5 over here along with IAS 21 with this specific requirement, with this specific one-liner item. So if you are mentioning your answer in this way, examiner will be giving you some professional marks if there are any within the question, within the section, that you have looked into the scenario very carefully and you have identified all the aspects of the scenario as mentioned by the examiner. So once we have looked into it, the currency of mainly financed through dinars, within dinars. Last thing is currency in which the entity retains its receipts from operations. So in which currency the company has retained its receipts, it's clearly mentioned it to protect itself from foreign exchange risk. Backlight retains cash in 3 currencies. So you're not aware of it. Which currency was decided by Backlight to retain its you can say its profits, its retained earnings. In this case, as it's not pretty much clear, so we'll be summarizing it. What would be the functional currency of this Backlight company based on the analysis we have done right now is most probably the dinar. right? We can say dinar is the functional currency of this company, and we can easily identify irrespective of all of this, but we have identified what is the functional currency based on this specific information provided within the question. We have not added anything additional from our side. We have just analyzed the scenario based on the requirement of the standard. So I hope you might have a good idea about it, how you're going to answer the question. You're not supposed to answer the question on your own. You're just getting the words out of the scenario and applying the standard on the guideline or on the issues highlighted by the examiner within the scenario. So with this application, you can easily answer your question. I'm looking into the answer of this one requirement to find out whether we are in the right direction. We have identified the exact aspects of this requirement or not. So looking into the answer, if you were looking into this scoring criteria, the scoring scheme that was provided, so you have in total 7 marks. Discussion of presentation and functional currency. We missed to identify what is functional and presentation currency. I believe if there is any requirement over here, what is meant by entities, presentation and functional currency. So we have missed this section altogether. Are you getting the point? Because we started explaining our question from this point. So this is something, a learning aspect for everyone, that we have to look into the whole aspect of the question, because while answering the question, I have started my answer from this main section. I've never looked into what is meant by entities, presentation and functional currency. So in this question, examiner has assigned 2 marks. Discussion of presentation and functional currency. So you might be losing 2 marks if you are not discussing what a presentation and functional currency actually means, right? So we need to consider that we would be answering the requirement as provided by the examiner in a way it is going to ask you the question. This will give you a better insight into it, how you're answering the question. So now I'm going to look at the answer. This answer is explanatory notes. Apology. This is the answer in this case. So you can see here explanatory notes to the director of carbides, as the requirement says you need to prepare a report, as it's mentioned that you need to prepare a report. The explanatory note, you're going to provide an explanatory note to the directors of carbides which addresses those issues which are explained in the requirement. So you need to explanatory note to directors. You can see the format: subject, foreign, subsidiary, backlight. The first requirement is the presentation currency is the currency in which financial statements are presented. This is as provided by IAS 21, and presentation currency could be any currency the company decided to. IAS 21, the effects of changes in foreign exchange rates, permits an entity to present its individual financial statement in any currency. That's one of the most important requirements. You cannot restrict the company that the company has to present its financial information, its financial statements in any specific currency. IAS 21 said the company, it's depending upon the company to present its individual financial statements in any currency the company wants to, right? But it would therefore be up to the directors of backlight to choose the presentation currency of the individual financial statements of the company. So it's depending upon the directors of the company. But factors which would be considered include the currency used by the major stakeholders, my shareholders, and the currency in which the debt finance is primarily raised. Why these 2 factors would be given by IAS 21, or for these 2 factors, IAS 21 gave the emphasis that the presentation currency should be most probably the currency in which is the major currency, or which is the currency of the major shareholders of the company, because they would better understand the performance of a company in a currency in which they know the currency well. For example, if I'm talking about UK, if I'm talking about UK, if there is a company within the UK and the company is providing its financial statements in dollars, so most of its shareholders won't understand what is the actual worth of this company, because most of the shareholders might not be able to find out what is the exchange rate at the date of financial statements, right? So they cannot ascertain the exact worth of the company. So the company which is located in UK, and most of its shareholders, like 90% of the shareholders, are from UK, and those shareholders have provided the funds within the UK, within UK pound. So the company is required, by default, the company is required to present its financial statements within UK pound rather in dollars. Secondly, the company has raised its debt finance primarily in UK pounds, so company has to present its financial statements in UK pounds so that the debt providers, the loan note providers, the lenders of the finance, the lenders to the company can better understand the situation of the company if it was provided, if it was presented within the pounds. I hope you get a link between these two. But IS 21, again I'm saying IS 21 won't restrict the company from presenting its financial statement in any of the currency. Only factor you need to consider is what was the primary currency. That is something to make sure we are we are adhering to the requirements of framework. Framework says that the information provided to the stakeholder must be relevant to the stakeholders. If you are providing the data to the stakeholders of the business, these are the two major stakeholders of the business, the lenders and the shareholders of the company. So if the lenders and shareholders understand UK pounds better, and you are providing the data in US dollar, it might not be suitable, it might not be relevant to those stakeholders. So you need to fulfill the requirements of the framework as well. I hope you're getting the point. Now we're looking into the functional currency. The functional currency is the currency of primary economic environment in which entity operates. Since transactions are initially recorded in entity's functional currency, the results and the financial position will need to be retranslated where it differs to the presentation currency, right? When determining the presentation and functional currency of backlight, consideration would first be given to whether the functional currency of backlight should be same as Carbise, as Carbise is the parent company, at least whilst under the control of Carbise. At what point of time? Up to the point of time when backlight was within the control of Carbise, at the point of time when the Carbise had not disposed of the backlight holdings, right? So it appears that backlight has considerable autonomy over its activities. It's not depending upon the parent company, it's not getting dictations from its parent company how the operation should be run. So that simply means that backlight is not bound to use the parent currency as its functional currency or representation currency. Despite being acquired to make more efficient use of surplus inventory of Carbise, purchases from Carbise by the backlight were only 5% of the backlight total purchases, which means backlight has its autonomous operations. It's not depending upon the Carbise to run its operations. So it means backlight is not required to use the same currency as its functional currency, which is used by its parent company. Next thing is revenue is invoiced in a range of currencies, suggesting a geographical diverse range of customers, which although this allows Carbise access to the new international markets, it is unlikely to be classified as an extension of the parent operations. The volume of transaction involved between Carbise and backlight would seem to be far too low to come to this conclusion. This whole paragraph up to this point only explain that backlight is autonomous in its operation and it's not depending upon the parent to run its operations, and it's not getting dictation from its parent to run its day-to-day operations. Backlight also appears free to retain cash in range of currencies and is not obliged to remit the cash to the Carbise in the form of dividends, as the backlight has not paid any dividend in last few years. I'm not sure how many years were there. In last, I believe 2 years. Backlight, no dividend had paid by backlight for several years, not specific years were mentioned. Nor does backlight appear to be dependent on financing from Carbise. How you know that backlight is not depending upon the financing from the parent company? Because the backlight has issued some debt instrument, and none of the debt instrument were purchased by the parent company, because the parent company is already in a process of disposing of its investment, its holding within the subsidiary company, the backlight company. Then in choosing its functional currency, backlight should consider the following primary factors. And one more thing I recommend everyone, this is a sample answer. This is just a sample answer. The examiner is going to give you as much detail as he can provide within the scenario. So if you are providing like 70 to 80% of the information provided in the scenario, you're perfectly fine. You have answered it very well. So I won't recommend you or any one of you, if he or she is worried about whether I'm supposed to answer that much detail. So it's not required. You only need to make sure you are considering the bullet points here which were mentioned. Like if this whole detail was not mentioned, no doubt if you provide, it's a very good answer. If you are not providing this detail, you are just explaining it that from the scenario, and you are mentioning one or two bullet points why you think that backlight is not depending upon the car buys, it's perfectly fine. As far as you are considering one or two main issues and just in one line or two line you're explaining it, that this is not the case for the solution, or for the understanding that car buy or backlight is an independent unit and it's not depending upon the parent for any of its operations. In choosing a functional currency, I'm looking into the next primary factors. In choosing its functional currency, backlight should consider the following prime factors: the currency which mainly influence the sale price of their goods, the currency of the country whose competitive forces and regulations determine the sales price, and also the currency which influences the labor, material, and overhead cost. The key determinant here is the currency which the majority of the transactions are settled in. Backlight invoices and it's invoiced in a large range of currencies, so it would not be immediately clear as to what appropriate functional currency was, what is the appropriate currency, nor is there detail about whether there is a currency in which competitive forces and regulators could be important. We do not know, for example, what currency backlight's major competitor invoice in. That's something we have already discussed when we're looking into the other aspects. Secondary factors, including the currency in which the financing activities are obtained and the currency in which receipts from the operation activities are retained, can help guide the entities where is not immediately clear. This is also not immediately clear in which currency company has retained its cash from the operations, or in which currency the company has mainly obtained the finances. In relation to backlight, a significant volume of their sales are invoiced in dinars and a majority of their expenses too. Given that wages and overheads also paid in dinars, funds were raised in dinar from the bond issues, and so it would appear that dinar should probably be the functional currency of backlight. That's something you are giving a clear-cut understanding, a clear-cut conclusion to the examiner. It is possible that the backlight may lose their autonomy on car buy sales of their shares, which would have implications on the determination of the functional currency. So that's another possible criteria out of it. But in this case, you have already identified that dinar is the functional currency, and presentation currency should be dinar of this company. So next requirement comes the next one. So I hope this is pretty much clear that how we are going to identify what is the functional currency of the company and how presentation and functional currency were explained by IAS 21. The next question is, you need to calculate the goodwill on the acquisition of backlight and what the balance would be at 30th September 2006 immediately before the disposal of the shares. Your answer should include the calculation. So before moving into the calculation, I will be explaining how you can account for the multiple subsidiaries when you are looking into your answer. So here comes consolidated statement of financial position. I'm just going through the consolidated financial statement very quickly. I'll be looking into any questions if there are any. Then it all depends. If you're going to answer in bullet points, then it's perfectly fine. If you are going to answer within the paragraph form, it's all depending upon you. But I would recommend that paragraph is far more better. A paragraphical structure is far more better. That shows more professionalism, right? And you can mention few of the points in bullets, so a mix of both paragraphs and a bullet points make more sense to me. No, not 35% of the suggested solution. I believe 35% is way a smaller solution, right? So I believe if you are making like 70%, 50 to 70% of the suggested solution, that make more sense. That's perfectly fine, because it's inherent limitation of all of the, I'm not sure, because we students have not very good in English communication. No doubt we have, but we are not that much good like those who have their native language, have their mother language English. So it is not possible for us to explain it in a very detailed notes that was provided by the examiner. So it is better to make sure that you are hitting the main points of the question section, the main points as mentioned within the scenario like we have discussed here. You have hit the main sections, the main bullets of this scenario. There are many issues those were not mentioned within scenario, but the examiner has always mentioned within its suggested solution. So if you are pinpointing the main issues highlighted within this section, it's perfectly fine, right? So if you want to attain a passing criteria, that is, if you want to attain 60 to 70% marks, is perfectly fine. You can answer like 70% of the suggested answer. You can easily gain that score, right? So that much detail the examiner is providing to make sure that you have multiple options within your mind, and you can answer the question. One more thing here is the examiner, once it's making a suggested solution, got a lot of time. He might be creating an answer within a day or 2 days, but as far as the exam is concerned, you might get only like an hour or less than an hour to answer a single question. So you better understand what is the difference of your understanding and the examiner's understanding, right? So it's not something the examiner is expecting you that you are going to answer the same thing what was mentioned in the suggested question, right? And one thing I have already told you in the previous class, that none of the question within SBR is right or is wrong, as far as you are justifying your answer with respect to the information provided within the question, and one of the student is providing a solution, another student is providing a B solution. As far as both of the solution justifies the scenario mentioned, examiner is not going to give you is going to deduct your scores, because both of the answers are correct as far as the scenario is concerned. Are you getting the point? And as far as your understanding is concerned, so that's more important in this case, how you are going to account it for. If there is any other question. Grammatical mistakes, most probably I would say yes, but not 100%. Yes, grammatical mistake has a negative impact, because examiner might not understand what you want to say, but it's not the case that this actually contributes to your failure. A slight grammatical mistakes is okay, but if you are making a lot of grammatical mistakes that don't give an understanding to the examiner what you are trying to say, then yes, that gives you some negative marks. I'll be looking into section B from tomorrow onwards. So let's start completing this one, and I'm looking into rest of the questions later. Okay, the next statement, next portion is related to the consolidated section. So important thing is there are basically 5 standards. Those are in relation to the consolidated section. IFRS 10, it's related to the consolidated financial statements. IFRS 11, joint arrangements. IFRS 12, disclosure of consolidated financial statements. IFRS 3, business combinations, and IAS 28, investment and associates. So these are the 5 basic standards. Those are giving you an idea how to account for. So important thing is why consolidation is required. So accounting concept, as mentioned in the framework, which is substance over form, that we have 2 basic nature of any accounting transaction. One is the legal nature, and other one is economic nature. We are always accounting for using or understanding the economic nature of a transaction rather than the legal nature of the transaction, right? Accounting will never consider the legal nature of a transaction. Accounting is always looking into the economic nature. What was the economic impact? So you might have learned your definition of an asset, asset is a resource controlled by business entity. It's not mentioning that asset is a resource that is owned by business entity. So ownership doesn't matter. If you are controlling an asset, like the most important criteria is under IFRS 16. IFRS 16 says leases. When you have acquired an asset under a lease contract, you effectively gain a control of an asset for a specific time period against the obligation you are paying to that specific entity. So you have to record the right to use asset against the payment you committed to pay it off. So what is the substance over form concept applied over here? For example, I would say there is a company, there is a Pakistani company, and it has a sub office in UK, and the sub office cannot perform any of its activities without the permission of the Pakistani companies. So the Pakistani companies is not required to create two separate set of financial statements, one for UK office and one for Pakistan office. The company is required to provide a single set of financial statements, one set of financial statement that was provided by the head office, which might be, if it is in Pakistan, then it must be reported by the Pakistani company, and if the head office was situated in UK, then the UK company must have to provide a single set of financial statements. In the same way, why? Because this head office is actually controlling the sub office. In the same way, if you are looking into the control into the parent and subsidiary relationship, I would say company A and company B, or company A acquires 99%, or sorry, suppose it's 80%. I'm not considering this thing over here. 80% of the share capital of the company acquires 80% of the shares of the company. Then it means company A has an effective control over the company B. So what economic aspect actually tells you that company A and company B both are a single company. As far as economic aspect is concerned, they're not different. If they are same, then you have to provide a single set of financial statement, just like you have provided in this case, right? So due to this main requirement, we are required to provide consolidated financial statements in this case. Now we're looking into what IFRS 10, IAS 28 and IFRS 9 stands for. For example, if you have a shareholding on mathematical basis, I'm not looking into IFRS 10 main requirements, I'm just looking into the mathematical aspect of the calculation aspect, that if a company holds 51% of the shareholding to 100% shareholding, it means the company has control over the other company. If you have a 50% holding, it doesn't mean you have a control. It means you have a joint control, just like IFRS 11 requirements, joint arrangements, right? So that's not the control, you can say. You don't have a significant control. If you have a control over a subsidiary, which means you have a majority of the shareholdings with you. And if you have this holding, then you can consider this as a subsidiary, and you need to consolidate it. And if you're consolidating it, you need to be able. We were looking into this in later point. I'm looking into the other aspect, that is IAS 28. IAS 28 says that you must have a significant influence over the company. Significant influence means you might have a holding of 20% to 50% shareholding. If you have 20 to 50% shareholding, you are exercising significant influence. You can influence the policy making of another company, right? So that significant influence make it an associate and should be accounted under IAS 28. But if you have acquired the shares of a company from 1% to 19%, so you are neither exercising control, you nor have a significant influence, you're going to consider that as investment and should be accounted for under IFRS 9, equity instruments, either at fair value through profit and loss or fair value to other comprehensive income, depending upon the intention of the management, what management intended with that equity instrument, with those shares. If a management intended to hold those instruments for a longer period of time, then these must be accounted for under under fair value to other comprehensive income. But if the entity intended to sell those equity instruments as a trading asset, then should be accounted for under fair value through profit and loss. So that's the case. Then if you want to consolidate it, you need to make sure that your parent company and subsidiary company both have the same accounting policies. Like parent company is following IFRS, the subsidiary must have to the subsidiary's financial statement, if prepared under any local GAAP, must be first converted to IFRS, and then consolidation only works. Otherwise, it just never works. Even in the case of associate, you need to make sure that your policies would be aligned with the parent company. So this is how you need to consolidate it. I'm looking into consolidated financial statements, multiple subsidiaries, how you're going to account for the multiple subsidiaries. I'm giving you an idea just, and then moving on to the foreign exchange gain losses on a subsidiary. So both companies, both the parent and subsidiary companies, first you need to create the individual financial statements of both parent and subsidiary company. You need to align the accounting policies of both companies, parent and subsidiary. Then you need to start the consolidation process. So consolidation process actually constitutes a 5 steps process. You have even studied it in F7. So first important thing is, in case if you are in F7, then you have to create a pro forma consolidated financial statement where you need to add parent plus subsidiary structure. The workings is, your first working would be group structure. You need to identify what is the group structure. If you have multiple subsidiaries, you can see here it's a subsidiary A, and in subsidiary A the parent company has 20% of the holding and rest is NCI. In subsidiary B you have 78% holding, rest 22% is your NCI. And in the same way, if you have a subsidiary C where you have a holding of 62%, NCI constitutes 38% of the group. So that's how you need to account for what is the group structure. The next step is net assets of subsidiary. So examiner is going to ask you these specific requirements. Rather, examiner is going to make you different calculation. So what is net asset? I'm just quickly going through it. Net assets mean assets minus liabilities. It simply means the capital section of the subsidiary is equal to the net assets you are going to calculate. So once working 2 is performed for multiple subsidiaries, simple processes, you need to calculate net assets of subsidiary A. In the same way, you need to make certain adjustments, those we have identified. Then you have to calculate net assets of subsidiary B again, and then you have to calculate the net assets of subsidiary C. Right? Individually, you have to calculate the net assets of all the 3 subsidiaries. So if you want to consolidate multiple subsidiaries, as this is the question which was asked by one of the student right now. If still my microphone is breaking up, I hope everyone is okay with the voice. It might be possible that any one of you have an issue with the internet. Okay, it's fine. Thanks, thank you so very much. So one of the student has mentioned that the voice was breaking up. So if it's breaking up, then there must be an internet issue with you. I have already checked it out. So if there is a problem, then do let me know. I'll be looking into the question section off and on. So if comes up, then I'll be explaining. Thank you so very much. So the next section, I'm looking into it. One thing, we have identified the net assets of subsidiaries side by side. So the next thing that comes in is the third step, or working 3, which is related to the goodwill of subsidiary. How you're going to calculate goodwill of subsidiary? What we are going to perform right now within the question we have. So you need to calculate consideration paid by parent, the amount that parent has paid to acquire the subsidiary. You have to account for non-controlling interest on acquisition date. This gives you the total consideration, irrespective whether a full goodwill method is used or cost method is used or partial goodwill method is used. You have to consider this. You need to account for this NCI at acquisition date. If cost model is used, if fair value model for NCI is used, or full goodwill method is used, then NCI is most probably given within the question. Like right now we have a question. In this question, NCI was already provided. If a cost model is used and fair value of NCI was not provided, we have to take the net assets of subsidiary at acquisition date, multiply by the NCI percentage to find out what is the NCI percentage or what is the value of NCI, right? So this gives you the total consideration, and you have to deduct net assets of subsidiary you have calculated at acquisition date, which comes from this working number 2, and this is the data. Once you have deducted it, you will find out goodwill at acquisition date. So this goodwill, any impairment within the goodwill should be deducted in this case, and the rest of the goodwill at reporting date should be the data you'll be getting it up here, right? Next thing is you have to perform this step for subsidiary B, and you have to perform this step for subsidiary C to find out the goodwill of subsidiary B and subsidiary C. So you have found out goodwills of subsidiary A, subsidiary B, and subsidiary C in separate calculation. So it's not difficult one. The only thing you need to consider is you are making the calculation one by one for each and every subsidiary. Same calculation must be repeated for NCI section once you move to the working number 4, NCI. So NCI of subsidiary 8 acquisition date, and this must be the same as reported in working 3. If you can see, I have already assigned it, I have already linked it. So this is the NCI at acquisition date. You can see this was linked from this to make sure that we are using the same value of NCI that was an acquisition date. Then post acquisition reserve multiplied by NCI percentage. You can see this post acquisition reserve was provided in working 2. This column 3 is post acquisition reserves of the subsidiary. It means any reserve that was created by the subsidiary after acquisition period multiplied by the NCI percentage which was provided in working number 1, and I have referred in this scenario, this working 2 multiplied by working 1. Impairment of goodwill. This impairment of goodwill should only be charged if fair value or market value of NCI is used. In this working, in working number 3, if fair value or market value of NCI is used, then impairment that was recorded here multiplied by NCI percentage should only be concluded here. But you don't need to perform this step if partial goodwill method is used. It means you are not assigning a fair value to NCI. So this step should not be performed, right? And NCI would you can come up with NCI at reporting date, this data. So NCI for subsidiary 1, subsidiary A, for subsidiary B, and for subsidiary C should be accounted for in the same way, just like the goodwill we have calculated. So these 3 steps should be performed one by one for each and every subsidiary, up to 100 subsidiaries if you have. There is one question, if you have like how many subsidiaries? Someone told me that there are 20 subsidiaries. So you have to perform these steps for each and every subsidiary, irrespective you have 100 subsidiaries. Next step is the group retained earning. So this group retained earning is a single working for all these subsidiaries. Group retained earning includes retained earning of parent on reporting date. You have to add post acquisition retained earning, which was provided in working number 2. Right now we have looked into it, multiply by working 1. Then post acquisition of subsidiary B, then post acquisition of subsidiary C, and then any impairment of subsidiary A, impairment of goodwill of subsidiary A, impairment of goodwill of subsidiary B, and impairment of goodwill of subsidiary C. You need to make sure you only need to consider parent percentage, impairment of parent percentage, if fair value of NCI was used. If partial goodwill is used, then you're not supposed to apply this parent percentage because you have not assigned any goodwill to NCI. So any impairment to the goodwill should be assigned to parent, because the goodwill is purely related to the parent if partial goodwill method is used, right? So that's how you need to calculate group retained earning, and then group revaluation reserves should also be concluded in the same way for subsidiary A, B, and C. Now your question would be how we are going to account for this goodwill. So when you are adding up assets, parent plus subsidiary plus subsidiary plus subsidiary, subsidiary A, subsidiary B, and subsidiary C, when you are looking into the goodwill, this goodwill should be added up. All the 3 subsidiaries goodwill should be added up in one line item in your balance sheet to show it up in the same way as you have calculated NCI. So NCI should be added up for all the subsidiaries within the working number 4 you have performed, right? So I hope it's pretty much clear for everyone that how the subsidiaries should be accounted for within the consolidated financial statements, and how multiple subsidiaries should be accounted for. Now, if you have a foreign subsidiary, what you're going to do with this foreign subsidiary? I'm going just showing you the working. You need to make sure whatever is the foreign subsidiary, you need to perform some additional workings just underneath this working. For example, if net assets, you need to perform few additional workings underneath this subsidiary A. If it's subsidiary B, then you need to perform some additional workings underneath this section. So I'll be moving to that Forex on consolidation section. So this is Forex on consolidation section. So you have performed working number 2. So this is something I have taken the same data from the previous example. Suppose subsidiary A is a foreign subsidiary. It's the same case. If you can look into it, it's the same idea. This is statement of financial position. This is net asset of subsidiary A, and subsidiary A is a foreign subsidiary. So we're looking into subsidiary A is a foreign subsidiary. The data provided within the subsidiary is in pounds, and the functional currency of the parent is dollars. So we need to convert net assets of foreign subsidiary into dollars. How you're going to convert it? Net assets of subsidiary at acquisition date, that should be reported in pounds. Post acquisition change in net assets, that must be reported in pounds. Then net assets of subsidiary at reporting date. So if you are going to add up, so this is the same data. You can see this is net asset of subsidiary at acquisition date, then this is net asset of subsidiary at reporting date, and it's the post acquisition difference. So if you are adding up this value plus this value, it will give you the same result, this value, right? Now you have to use the exchange rate. IS 21 specifies within the consolidated financial statements, exchange rate must be applied. The opening exchange rate and the closing exchange rate must be applied to the assets or liabilities of the subsidiary. But for income and expenses section, you have to use the average rate. You have to use the spot rate. These are the two requirements. Translate all assets and liabilities of subsidiary into parent currency using the closing exchange rate or the opening exchange rate. I'm mentioning both, a closing exchange rate or an opening exchange rate. Opening exchange rate should be used for opening assets. Opening exchange rate, which should be denoted as OER, open rate, and all the income and expenses of the subsidiary should be accounted for using the average exchange rate. So just giving you an idea, these are the opening net assets of subsidiary. Net assets means the assets of subsidiary minus liabilities of the subsidiary. So you are going to apply the opening exchange rate or the spot rate. Spot rate includes the spot rate means the exchange rate on a specific date. Average rate means it's an average of certain time period. So if you are translating opening value of an asset, then you have to use the exchange rate of acquisition date. In the same way, if you are using the net asset subsidiary closing date, you need to use the closing exchange rate. Then for this post acquisition is actually the change in net assets, as net asset is the capital section of the subsidiary. As you mentioned earlier, net assets is equal to the capital. So there is only one change made to the capital is because of the income or expense. Everyone know that capital structure of the company changes because of the profit made during the year due to the total comprehensive income done by during the year. So there could be change in share capital and share premium. As you have seen, I have mentioned it's 0. There is no change in share capital and share premium. So rest any changes made to the net assets is related to the income and expense. So we are going to use the average exchange rate in this case, right? But once you are going to translate it, this data doesn't match. There could be some balancing figure that's named as foreign exchange gain and losses. These foreign exchange gain losses must be reported in other comprehensive income. That's a conflict in IAS 21. IAS 21 said any foreign exchange gain losses related to individual transaction should be reported in profit and loss account, while at the same point of time, IAS 21 said if there are any foreign exchange gain and losses that rise in consolidation should be reported in other comprehensive income. So we are going to update these in other comprehensive income. The next step you are going to perform is the goodwill of subsidiary. So goodwill is always calculated in pounds within the currency of the parent. You have to perform some additional working here as well, and the working would remain the same like net asset. Opening goodwill, you have to calculate goodwill at acquisition, the opening goodwill, and as it is an asset, you have to use the opening exchange rate, the spot rate. Then you will be provided with the goodwill value at reporting date in pounds, and you need to convert it using the closing exchange rate, the spot rate of the reporting date. And there might be impairment on the goodwill. This impairment of a goodwill, as it is an expense, so you are supposed to use the average exchange rate in this case, right? And which is provided within the question right now. We're looking into it. Then foreign exchange gain losses could be a balancing figure, and that should be charged to other comprehensive income. So that principle remains the same. While for non-controlling interest, you have to calculate the non-controlling interest in dollars altogether. So non-controlling interest of subsidiary at acquisition date multiplied by acquisition date exchange rate. So that's something you will be getting out. Post acquisition reserve multiplied by NCI percentage. These are always provided in dollars, and we have already converted into the dollars. Impairment of goodwill. This impairment of goodwill is already converted into dollars. We need to multiply this one section. If you can see, I believe I have not mentioned, but this goodwill should be accounted for. But one more thing, this is also explained here. If full goodwill method was used, then you're not supposed to apply this foreign exchange. Another step that you need to perform when you are calculating NCI, if full goodwill method is used, you can see here, if full goodwill method is used, only foreign exchange on net subsidiary multiplied by the NCI percentage, you are calculating this, right? This is something additional items on consolidation of foreign subsidiary. If within NCI, you need to add up these two things. Any foreign exchange gains or losses on the translation of net assets of a foreign subsidiary should be assigned to NCI. But foreign exchange losses on goodwill should be accounted for in the same way as you have accounted for this impairment, right? If a full goodwill method was used, only then this foreign exchange gain losses on the goodwill should be assigned to NCI. But if partial goodwill method is used, then as goodwill is not associated to NCI, you cannot assign any gain losses on the retranslation of goodwill to NCI because it doesn't belong to NCI. I hope it's pretty clear to everyone. And another thing you need to perform when you are translating a foreign subsidiary, you need to add up your foreign exchange gain losses to working number 6, that is group revaluation reserve. Why? This is retained earning, and we are not going to update other comprehensive income within the retained earnings of the company. If there are gain losses reported in other comprehensive income, those must be assigned to group revaluation reserves or group other reserves, not to the retained earning. So over here we have mentioned it, foreign exchange gain losses of subsidiary multiplied by parent percentage and foreign exchange gain losses on goodwill of subsidiary multiplied by parent percentage, but parent percentage should only be multiplied if fair value of market or market value of NCI is used. If cost method for NCI is used or partial goodwill is used, you're not supposed to multiply with this goodwill foreign exchange gain losses on goodwill. You only need to charge all the foreign exchange gain losses to the parent company, to the parent rather to the NCI, right? So this is how the working should be performed. Foreign exchange gain losses. An important thing is what we are going to do with these foreign exchange gain losses, which was already concluded within this question. Once the subsidiary was disposed of, how we are going to account for with these foreign exchange gain losses. These foreign exchange gain losses should be recycled to the profit and loss account. That's something it's specifically mentioned within IAS 21, that any foreign exchange gain losses, those arises on consolidation of a foreign subsidiary. Once the subsidiary was disposed of, the accumulated gain losses should be charged to profit and loss account. Those should be recycled to profit and loss account. Recycling means what? Those revalues, those foreign exchange gain losses should not directly move from other components of equity to the retained earning, but those first should be charged to profit and loss account as either income or expense. That will ultimately increase the profit of the year, and with the increased profit, that profit goes into the retained earning ultimately. Right? Any question right now? Yes, it should, for goodwill, foreign exchange losses should be reported and recognized in other comprehensive incomes. Repeat treatment of goodwill related to what? I don't get the point. One, What is perp? Okay, I'll be looking into the perp, but at the end of this session, we need to complete the question. Right now, I'm just asking, looking into. If you have any question, once we are done with this question, do let me know. I'll be giving you an understanding what perp actually means. Why we use full goodwill or partial goodwill? Any logic? Okay, that's a very good question. Anyone else have concern about why we are using full goodwill method or partial goodwill method? Full goodwill is used when you have the fair value of NCI is available, and it should be used in priority. If you have fair value of NCI available with you, IFRS 10 said it must be used in preference, because this gives you the real picture of the company, what the market participants is considering about the company. Are you getting the point? But in most of the cases, fair value of NCI is not available, or we can say in few of the cases, we might not have NCI fair value available. So how we can find it out? But we have to consolidate it. So in that situation, IFRS 10 allows you to use a partial goodwill method, because as we are not able to identify the fair value of the NCI, hence we are assigning the cost of NCI as the NCI. So in that case, we have not assigned any goodwill to the NCI, right? So in that case, we are using the partial goodwill method, but that is our limitation. That's not something IFRS 10 explicitly allows. IFRS 10 always recommend use the full goodwill method. You are always required to use the full goodwill method. That is, you have to have tried your best to find out the fair value of NCI. If it's not possible to find out the fair value of NCI, only then as a option for you to consolidate the financial statement, IFRS 10 allows you to use the cost of NCI rather using the fair value of NCI. I hope it answers your question. Okay, we'll be moving to our question now. I hope we are done with most of the issues. There are few of the questions that I'm intentionally leaving. I'll be looking into those questions at some point later. So if anyone has a question, one by one, you can tell me, and I'll be answering those questions. Let's come back to our requirement, which was over here. This is something, a calculation of goodwill on the acquisition of Backlight and the balance for 30th September immediately before the disposal of shares. Your answer should include calculation of exchange differences on goodwill for the period from 1st January 2006 to 30th September 2006. So it's asking me to calculate the goodwill. So if I'm going to calculate the goodwill, I'll be opening up this Excel sheet. I'm working on it. So how you're going to calculate the goodwill? Goodwill will be calculated in as it's reported in dinars. So I'm looking into dinar millions, right? So goodwill, whenever you're going to calculate the goodwill, we need to make sure that how we're going to consider consideration, how we're going to start it, consideration paid by parent. And what is the parent company? I believe parent company was, what is the name of parent company? The parent company name is Carbise. So why I am mentioning the name of the company rather naming it as a parent, this will put in a good impact on the examiner, that you are using the words provided within the examination, within the scenario, rather using an hypothetical word for the parent company. So always try to make sure you are using the scenario as much as you can. That will provide, that will left a very positive impact on the examiner. So always try to make sure you are using maximum, you have tried a maximum to use the words those were mentioned by the examiner. So over here, consideration paid by parent, what was the value of consideration paid by parent? This is acquisition of Backlight. So you have acquired 80% and cash paid was 100 million dinars. So you have paid 100 million dinars, and after paying 100 million dinars on 1st January, the net assets of Backlight at that was 60 million. So I'm not going to consider the net assets of subsidiary right now. The fair value adjustment deemed necessary was in relation to a building which was valued at 20 million dinars above its carrying value and the remaining useful life 20 years. Car buys may non-controlling interest of fair value less for acquisition, and the fair value of 20% interest was estimated to 22 million. So another thing, that is NCI at acquisition date was 22 million. So what was the total consideration for the whole subsidiary? Total consideration for the whole subsidiary equals this 122 million, right? Now you have to deduct net assets of Bike Light at acquisition date. So what is the net assets value? The net assets at acquisition date, those have a carrying value of 60 million. So we can mention 60 million, but on top of it there is a fair value adjustment, and that fair value adjustment is related to a building, and which is 20 million dinars. It has a carrying value, and it has in excess of, and a fair value of 20 million and above. So in excess of carrying value, so this is a further 20 million. So the carrying value, the fair value of net assets at acquisition date of Bike Light is 80 million. So if you're going to calculate the goodwill, so the goodwill value is goodwill at acquisition date. So the goodwill at acquisition date value is 122 million minus this 80 million. So it's 42 million. I hope it's pretty much clear for everyone how we have calculated the goodwill at acquisition date. Any problem till now, do let me know. Now, as this was reported in dinars, we need to make sure that we are going to retranslate these dinars into dollars. I believe dollar is the currency of parent. Yes, dollar. So we need to retranslate it. So we're looking into dinars millions, then looking into exchange rates, and then dollar millions, right? So what is the goodwill at acquisition date? Goodwill at acquisition date was somewhat, I'm just looking into it. What is the value of this goodwill as acquisition date? It's 42 million, and there is some sort of impairment, and impairment should be charged as 6 million. I hope we have acquisition date and reporting date. After reporting date, we'll be looking into goodwill at reporting date. So goodwill at reporting date would be given as this 42 million minus the 6 million. Now, just looking into the suggested answer, I'll be mentioning acquisition date was 1st of January 2002, and goodwill at reporting date would be a reporting date I'll be first considering, because impairment was done on, I believe impairment of this goodwill was done on due to relative poor performance. Bike Light was decided to impair the goodwill by 6 million dinars during the year ended 31st December. So up to 31st of December 2005, the goodwill was impaired by 6 million, right? So if we're looking into this reporting date, that was 31st December 20x5. First, I'll be looking into goodwill at 31st December 2005, and then I'll be looking into the goodwill value on 31st on the next date, which was when the subsidiary was disposed of on 30th September 2005. That would be the next step to calculate the foreign exchange gain losses. As why I'm doing so, because examiner has told me you need to find out the foreign exchange gain losses on the goodwill from a period of 1st January 2006 to 30th September 2006. Are you getting the point? So between this time period, examiner is asking to calculate the goodwill, the difference between this goodwill. So goodwill is 36 million on 31st December 2005. So if there is any foreign exchange gain losses, we'll be looking into it. So exchange rates would be, what is the exchange rate on 1st January? It's $1 equals 0.5 dinars. It means if dollar is of a bigger amount, then I would be creating 0.5 as exchange rate. For impairment, you need to calculate the average rate for the year ended 31st December. You can see the rate was always given, just 0.4, and I need to move it a bit down so that again exchange differences, exchange forex I would name it as forex gain losses. This is 0.4 million. And what about 31st December exchange rate? It's 0.38. Fine. Now we'll be looking what is the value in millions. So this 42 million divided by the 0.5. So value is $84 million. Impairment should be reported in this way: 6 million divided by this $0.4 million, and the closing value would be this 36 million divided by 0.38 million. So it's 94.95 million or 94.7 million. Do you think this totals equals? This should be the balancing figure. This balancing figure, how we're going to calculate this balancing figure? Total of 84 million plus this 15 million must equals this 95 million, right? So there is a difference of 4 million, I believe. So this 4 million should, if this is the 4 million, 85 million, this is 99 million, it's a loss of 4 million. Oh, sorry, it's as this is impairment, so this impairment should be reported negative. So it's a difference of, this difference is these two values. You can say it's, what about this 126 million? How we have calculated this? Okay, this is 48 million, 126 million. How we have calculated this 126 million, 48 million. Okay, fine. Yes, 126 million. So what is the difference? What the difference that should be reported is this value, and we can say it's this value minus this value plus this value. So it's 27 or 27 million. I would suggest. So how we are going to calculate it? The value is, oh sorry, this is not 48 million. This should be plus. This is 36 million. Now this is the correct one. So if you're going to calculate it, this 84 million or this 95 million minus this value and plus this value, this is something, give me a second. This total value is 69 million. So 69 million, I would be calculating it this value, 95 minus 69 million. So the difference is 25 point some million or 26 million, I believe 25.7 million or 26 million. So I'm going to round it to 26 million. So the balancing figure, how you need to calculate is this 95 million, or you can say the total of these three must equals this 94.73 million or 95 million. So this is equals, hence this is a foreign exchange gain. Why you can say gain? Because the goodwill value after charging impairment in dollar millions was will be equal to this plus this value. It's 69 million. But as the value of the goodwill has increased in dollar millions, you need to debit goodwill. You have to debit goodwill and you have to credit foreign exchange. So anything that goes into credit entry is an income, right? So we are going to consider it as foreign exchange gains. Next reporting date would be, this should be the opening for the year ended 31st December 2006, while as the subsidiary was disposed of, so we need to calculate goodwill on disposal date, which was goodwill at what date? At 30th September 20x6. So what is the value at 31st December 20x6? The value would be this 36 million. There is no change, but we have to calculate the foreign gain or losses, which is the balancing figure for us. And I'm going to calculate the foreign exchange gain losses once again. What is the exchange rate on 30th September 2006? So the exchange rate on 30th September was 0.35 million. We are not going to use this average exchange rate. This average exchange rate was given for some other sort of calculation. Right now we have to consider, because there is no impairment on this period. Impairment was only for the time period of till for the end 31st December 2005. Later there is no impairment on the goodwill. So the exchange rate is 0.35. So I'm going to consider 0.35, and I have to calculate the same working, and the goodwill value is 103 million. So what is the gain increase in value of goodwill? That is 8 million. Fine. So this 8 million should be considered as foreign exchange gain, another gain. So the total gain that is reported on the goodwill would be 8 million. Now looking back into the requirement, what was the requirement the examiner is going to ask us is a calculation of the goodwill of acquisition backlight, and when the balance and what the balance would be 30th September 2006, immediate before the disposal of the shares. Your answer should include calculation of the foreign exchange and goodwill and the period 1st July 2006. So you have already calculated it, and you need to explain. I believe if there is an explanation, no explanation is not required. So 5 marks is allocated to the calculation of goodwill. In the very next requirement, an explanation of your calculation of goodwill and treatment of exchange differences on the goodwill in consolidated financial statements. You do not need to discuss how the disposal will affect the foreign exchange. So right now you're not disposing of the goodwill. You have to provide the explanation how you accounted for this goodwill. So anything that we have done, why we need to multiply it? Yes, value of 48 was wrong before. I missed the value. So it should not be divided. Someone has asked that the rate should be multiplied. It should not be multiplied. To give you an understanding for exam perspective, you can see here, if you look the ratio, dollar is higher. So you can get $2 with 1 dinar, right? So the value, if you are going to translate from dinars to dollars, the dollar value should be higher, right? If you are multiplying 42 with 0.5, it will give you the dollar value in lower sum. So you always need to make sure you are understanding what value is higher. So result should be higher. If the dollar value was lower, in this case, suppose we can look into $0.5 equals 1 dinar. It means dinar, the dinar value once converted into dollars would be reduced, because a lower amount of dollars will be converted into higher dinars. But in this case, this is a vice versa, different situation, right? I hope it's pretty much clear to everyone why we are going to divide this one, because dollar value was higher and dinar value is lower. So if these are 42 million dinars, it must end up in more dollars compared to dinars, right? That's why I have divided it. Okay, what explanation required? You have to explain it how you have calculated the goodwill. So explanation of all these calculation one by one. We have to consider the consideration paid by the Carbice company of 100 million, along with, and add up the fair value of NCI at acquisition date to come up with the total value of the company. While the value of company in this situation is 122 million, and the net asset of subsidiary at acquisition date, the fair value of net asset of subsidiary, also the carrying amount of the net asset of subsidiary was 60 million, while there is a fair value adjustment fees of 20 million. So we have adjusted, so we have found out the fair value of net asset acquisition date was 80 million, and by deducting this 80 million from the total consideration value will give you the goodwill of about 42 million dinars at the acquisition date, right? On what date? That was 1st of January 2002. Now you're going to explain what impact of this impairment would have. So you must have been telling that this goodwill should be, or the foreign exchange should be, reported in other comprehensive income. These foreign exchange gain losses. So you must be explaining it. Once we are going to translate this goodwill from acquisition date till 31st of December 2005, so there is an impairment loss on the goodwill of Bakelite, and this impairment equals 6 million dinar, which should be reported in consolidated financial statement as an impairment of $15 million. That should be charged to profit and loss account. While translating the foreign subsidiary within into dollars, from dinars into dollars, the goodwill at 31st December 2005 for this subsidiary was 95 million, which gives a gain, foreign exchange gains of 26 million, which is a balancing figure, and this gain should be reported in other comprehensive income. Now we are not considering what we are going to do with the disposal item. We are just looking into it. What is the value of goodwill or what are the foreign exchange gain losses till December. There is another foreign exchange gain reported on the goodwill of subsidiary, on the goodwill of Backlight, which totals 8 million. So the total of 26 plus 8 million foreign exchange gain losses should be reported to other comprehensive income in the respective periods. Like 26 million should be reported for the ended 31st December 2006, and 8 million of foreign exchange gain losses should be reported in other comprehensive income on 30th till 30th September 2006, right? But we are just mentioning this till 31st of, oh sorry, 30th of September 2006, because within this question, the examiner has asked us an explanation how we are going to account for these differences. So any workings can be in the main body. So you have explained these gain losses, and those should be reported in other comprehensive income, but you have to ignore the disposal aspect. The disposal aspect should be included over here. This is the next requirement. Explain why exchange differences will arise on the net assets and profit or loss of Backlight each year and how they should be presented within the consolidated financial statements. Your answer should include a calculation of foreign exchange, which would arise on the translation of Backlight excluding goodwill. So in this case, you're not supposed to calculate the goodwill foreign exchange, because you have already calculated. You need to make sure what is the foreign exchange gain loss that should be reported on net assets of subsidiary and profits of subsidiary. So in this case, if I'm looking into the net assets of subsidiary, I believe those net assets were given within the question. Over here, if you're looking into the net assets question, so net assets on acquisition date were always available. The group operates sector, the acquisition was enabled, so 80%. These are the net assets on acquisition. So the net assets of subsidiary carrying amount on acquisition date was 60 million, plus a fair value of those net assets were given as well. So I'll be looking into the net asset subsidiary at acquisition date of Backlight at acquisition date, which was given as what is the value? Net assets of Backlight at acquisition date. What is the total value? So total value is given as, I believe, 60 million, right? And you have to make fair value adjustment on this acquisition date, which was 20 million. So total value is 80 million dinars. I'm just considering it in dinars, right? So after considering these in dinars, you have to consider what is the post acquisition, if there is any profit provided in the post acquisition period. Within this scenario, 50% of so this is the trading activities. This value about the carrying out for 20 million, car buys may not controlling interest due to 22 million due to the relative performance of the decline. So rates, exchange rates, so dispose of. So these are, I believe, carrying amount of Backlight's net assets on 1st January 2006 and Backlight loss for the end of 31st December 2006. So in this requirement, we need to make sure what was required in this. So you need to every time you need to consider what was required. So the question is asking you exchange differences arising on net assets of Backlight. Your answer should include a calculation of exchange differences which would arise on the translation of Backlight excluding goodwill in 30th. So exchange gain losses to what time? So the carrying value of Backlight assets for 1st January was given, that was 48 million dinars. Backlight loss for the year ended was 8 million dinars. So that actually give you the result of this thing. So I'm just mentioning it here. Net assets of dinar, that's something you have calculated on acquisition date, that was 1st of January 20x2. But as this specific requirement was not given, because afterwards, if you're looking into this answer, but once you're creating your answer, you might be making this calculation. But once you come to know that afterwards on 1st of January 2002 till 31st of December 2005, there is no data given with you. So what we are going to do, we need to make sure that the fair values or fair value of net assets or the carrying amount of Backlight net assets on 1st January was given as carrying value of backlight nets on 1st January were given as 48 million, right? So fair value adjustment, you need to make sure fair value adjustment must be made. This fair value adjustment was not made in individual financial statement. The data provided in this section is for the individual financial statement. So the fair value adjustment for individual financial statement, so for consolidation, was this 20 million. How many years have been passed up to this point till the 1st of January 2006? So this 20 million divided by 20 years, the remaining useful life of this building was 20 years. What we have adjusted the fair value over here, where was the 20 million dinars, the fair valuation carrying amount, and useful life is 20 years. So this is the value of 20 years. Fair value adjustment you have made. Oh, sorry. Right now I'm just making the fair value adjustment. You have to deduct any additional depreciation. How much of the additional depreciation should be charged from 1st of January 2002 till 1st of January 2005 is 31st December 2002, 31st December 2003, 31st December 2004, 31st December 2005. So there are 4 years for which additional depreciation should be charged. So that means divided by 20 years, multiply by 4. So this is the depreciation of 4 million that should be charged to this. So adjusted carrying value of backlight net assets should be given as this total. You can sum it up. So it's 64 million. Is it clear? But this was mentioned in dinar. I believe we have this data available in dinar. You can see carrying value of backlight net assets, it's in 48 million dinars. So we have calculated all these values in dinar millions. Anyone has any confusion till this point? I'm looking into the question. If someone has a confusion regarding impairment of goodwill, if NCI is measured in fair value in consolidation, we have collected the isn't the consolidated retained earning and consolidated profit and loss is same? No. Why not 4 years and 9 months? Because right now we are going to calculate the adjusted carrying amount of backlight net assets on 1st of January 2006. One more thing, someone has asked the question that consolidated profit and loss and consolidated retained earnings is surely a different thing. If you're looking into consolidated profit and loss account, that consolidated profit and loss account should be assigned to NCI and parent, while retained earning is purely related to the parent. NCI portion was excluded, so that's why we are making sure that we should not be accounting it for the question retained earning, and the other thing was different. Yes, this recording would be available. I hope this is clear. It's not for 4 months, 4 years and 9 months, because 9 months we are not calculating for the 9 months. 9 months should be accounted for right now, because these are the adjusted carrying value of net assets at what date is? It's 1st Jan 20x6. Is it clear? Now the next working you'll be looking into it is explanation of goodwill related word. I agree, you're not supposed to make this working. This is just to give you an understanding how these values should be calculated, right? The 64 million should be calculated in this way. Next is you need to calculate the loss for the year. What was the loss that was given in the question? That loss was 8 million dinars. So you have this 8 million should be deducted, 8 million, and the net assets. Okay, loss for the year, but as the subsidiary was disposed of after 9 months, so we have to consider the loss for only 9 months. Divided by 12 multiplied by 9. So this is the loss that should be accounted for the year end. So if you have considered this loss, so the carrying value of net assets of Bakelite at 30th September 20x6, because afterwards you don't have subsidiary available with you, so you cannot record the. So this would be the value. If you are converting it into dollar millions, what would be the value? Dollar millions. This is for your understanding. If someone don't understand it, do let me know. So adjusted value, we have to use the exchange rate on 1st of 31st December 2005, that was 0.38 million dinars, because 1st of January or 31st December is the same date. Just moving it further, and this is Forex rates. Forex rate should be applied 0.38 million, and average rate should be applied to the profit and loss during the year. Bakelite loss, cumulative gain losses in Bakelite 1st January. This was exchange rate 30th September, and average rate 0.37. Average rate was 0.37, and this rate was 30th September 0.35. Right? So you can calculate the value. How you're going to calculate this? 64 million divided by 0.38. It's this value, and I'm going to replicate all these values over here. So this is 165 million. Any foreign exchange gain losses, which is balancing figure, should be reported over here. So, oh, sorry. So I'm going to delete this one, and we are going to mention what is the Forex gain loss. Forex gain losses. It should be the balancing figure. So what is the balancing figure? You need to explain this balancing figure using this value. If I'm making it 152.20, so I'll be looking this working in this way: 162 plus this value, and if this is the figure, then 165 minus this value. So $13.50 million is a foreign exchange gain, because your value of your asset have been increased. So it's a gain. That gain should be reported in other comprehensive income. Now, if you want to explain these things, if you want to explain this, which was required by your examiner, explain the foreign exchange differences arises on these, and your answer should include calculation of foreign exchange differences, which should arise on translation of Bakelite for the year ended 31st December. So you must be mentioning that these amounts, these foreign exchange gain losses, should be reported in other comprehensive income, and we're going to retranslate the net assets of Bakelite during the year ended, and we have to translate the opening net asset value, which includes this fair value adjustments along with the additional depreciation of the 4 years. I think there is another depreciation that I missed, I believe. Loss for the year. Along with this, there is a 9-month depreciation that should be accounted for, and we have not concluded that. Right, the 9 months depreciation that someone is telling me, but unfortunately I have not concluded the depreciation. You can add that depreciation as well. That is 20 or 1 million. 1 million divided by 12. It should be minus 1 million divided by 12 multiplied by 9. So this is another depreciation that I missed. Right, so that's something. Whenever you are working on such a complex situation, you might miss 1 or 2 points, but don't you consider that by missing a single point, examiner is going to deduct the whole answer. If your whole scores, if you look into it, explanation for exchange differences, that scores 3-month, calculation of Bakelite exchange differences for the ended 31st December, translation is 3 million, split between parent and NCI is conclude 1 score. So these are the total exchange gain losses, foreign exchange gain losses. Those should arises on the translation of net assets. So you have to bifurcate it between parent and NCI. Parent concludes 80% of these foreign exchange gain losses, that totals this value, and NCI constitute 20% of these foreign exchange gains. So these are attributable to NCI, and these foreign exchange gains should be attributable to what's the parent company name? I'm always using the parent company name to make sure that that you would be using the parent company name whenever you are calculating it. What is the parent company name? Parent company name is, I missed the parent company name. That is Carbise. So Carbise share. So this is how you have split these two things. So you need to explain, once you have made these calculations, now you need to explain to the examiner what I have done in my working. So you need to be explaining starting from this point till the end of this point, right? With this bifurcation to Carbise and NCI of the group. So you're not supposed, you're not required to make some additional adjustments. So you need to explain something additional. You're going to explain the same thing what you have calculated, right? I'm looking into the answer to make sure whether we are in the right path or in wrong direction. So before looking into this, I'll look into if our explanation of particular transaction differs from our model answer. But if we have explained our points, we'll get the marks. Specifically to the question, the recent question, can we take the, yes, we're going for a break. Foreign exchange when calculating goodwill is under OCI or profit and loss account. Foreign exchange on consolidation. Remember one thing, foreign exchange on consolidation should always be charged to other comprehensive in income, irrespective this foreign exchange gain was based or is calculated on goodwill or is calculated on the net assets of subsidiary. We are not going to differentiate, right? If your explanation differs from what you have calculated, then we have to calculate. Is the no, we have to consider. Right, give me just give me 1 second. I'm going to answer the first one. If your answer model is different and if your discussion is different, obviously there's a conflict between what you are explaining. So I'm quite sure examiner is not going to give you scores based on the conflict. You must be explaining what you have calculated. As this is Excel, it's not it's not a paper-based exam. So if there is any mistake done within the exam, you have very good opportunity. You can go back and change your calculation from there. But I would recommend once within exam session, once you have done with your calculation, don't go back and forth, because while going back and forth, you might be losing your time and you might be making more confusion for yourself. So I always recommend once you are done with your calculation, never go back and look into your calculation, just explain what you have calculated, right? Because if you are moving to and forth in your calculation, you might be spending a lot of time in correcting your mistakes, and that in that way you're losing your scores, or you're losing your time, and you might not be able to spend much time. You might not be left with much time for your next questions. So you need to be very careful. Once you are done with your calculation, make sure in the first place you have did a very good effort in attempting your question. Once you are done with your calculation, you must be explaining what you have done rather making a different explanation. Next question was additional depreciation for 9 months should be considered, because for the next 9 months a Carbise, the parent company, has within its group accounts the subsidiary, and the fair value adjustment related to the subsidiary must have an additional depreciation impact. So that's why it should be included. Foreign exchange share of NCI shows as NCI or translation reserve in consolidated balance sheet. So for NCI, this is something. Another question was if foreign exchange share of NCI should be reported as NCI. It should always be reported as NCI. Now, to understand this concept, you need to consider if you are considering, for your understanding purposes, the parent or the group, as NCI is a smaller portion of the subsidiary. NCI is what? NCI is the shareholder of the subsidiary, like the 20% shareholding of the subsidiary which parent has not acquired. So parent asked the NCIs, this is the total share of your profit and loss account and your other comprehensive income. I'm not going to bifurcate and profit and loss account and other comprehensive income for you. I'm going to tell you this is the total share of yours, including both profit and loss account and NCI. So for NCI, we are not bifurcating between other comprehensive income and profit and loss account. But for parent, as those are the main stakeholders of the group, the major stakeholders of the group, so the parent company or within the consolidated financial statement must have to bifurcate between the real gains, the actual gains, and those gains which are based on, which are unrealized gains, you can say. Realized profit and loss, realized gains, those are reported in profit and loss account, and unrealized gain losses, those should be reported in other comprehensive income. So you must be giving a bifurcation between these two, right? Yeah, exactly. It's far more, it's one of the best option if you are making calculation with an Excel file and you are explaining it within the Word file. Yes, explanation must work in the same way. But if you're using the Excel file, I believe that is okay, but it's highly recommended that you must be using the Word file for your explanation. So I'm just moving to the explanation to make, I'm just going through the explanation, what explanation it's, what requirement it's C requirement, what we're looking into. No, it's B requirement, B1, to which we are answering this score 7 marks. So I'll be looking into number 2, working B answer. Okay, for B, examiner has first explained it. I believe an examiner must be providing the workings. Yes, examiner must have provided the working as well. You can see here, these are the working, but these workings are done at the end of this question. So if we have done the calculation first, then it would be easier for us to explain something. I have always told you that this sample answer is in a very real time, is not it's in a very best situation answer. In real time scenario, you must be answering it in a way which is more suitable for you. So first, I always recommend to make up your calculation and then make up your explanation, because explanation is derived from what you have calculated. If there is any different, do let me know. The net assets of backlight would have been retranslated each year at the closing exchange rate. There is therefore an exchange difference arising on each year comparing the net assets at the opening rate of exchange and opening net assets closing exchange rate. Any additional exchange differences arises to profit and loss account backlight each year being translated at the average rate of exchange in consolidated statement of comprehensive income. The profit loss will increase or decrease. The net asset of backlight respective, which is indicated above, will be translated to the closing exchange rate with the consolidated financial statement position as with the goodwill. So this is the whole explanation of what we have actually calculated, and you can see this is the actual explanation of what was done. The carrying amount of backlight net assets on 1st January 2000 X6 was 48 million dinar as provided within the question. The fair value of their opening net assets therefore would be 64 million dinar. How? 40 million dinar plus 16 million, because rest of the amount was charged to the profit and loss account. The additional depreciation, the 4-year depreciation, we have actually concluded in this way. Then backlight would only consolidate for the first 9 months since the Carbise loses control on 31st December. So the additional depreciation should be charged for the 9 months as well. Are you getting the point? Yeah, this is something, it was already mentioned within this section, right? So this is how you need to explain. I'm not going to discuss rest of thing because it's the whole explanation of what we have done, and this is 10.7 million of exchange differences are attributable to shareholders of Carbide. It's Carbide or Carbise, I believe. The answer within the answer, Carbise, not Carbide. Might be I have mentioned it in a wrong way. Carbide, it's Carbise, 80%, 13.4 million and 2.7 million to NCI. You can see this one line concludes one score, one complete score, this just one line. If you're mentioning this, and it's not a difficult one, right? So you need to make sure you're answering it in a correct way. We have already discussed when we are looking into the main aspect of this one. So the last requirement is working number 3, which was C option, calculate the group profit on disposal of backlight. Briefly explain how backlight should be treated or presented in consolidated financial statements of Carby's for the ended 31st December 2006. And this concludes 4 marks. This concludes 3 marks. So after 10 to 15 minutes breaks, I'll be back. And no, I have multiple times I have mentioned that our answer should not be as much detailed as the model answer is, because model answer is developed in a very best situation, and it was developed by the examiner. So examiner might have a very huge amount of time to answer the question, right? But you have only 3 hours to answer this question. So I'm not considering that you might be giving that much explanation to your answer. Foreign exchange share on NCI shows as NCI on translation reserve in consolidated balance sheet. Yep. Foreign exchange share of NCI should always be reported as NCI in consolidated balance sheets. It should not be reported in any other reserves. It should only be reported under the head of NCI. So we have 10 to 15 minutes break, and I'll be back after 10 to 15 minutes break. I'm not going to pause anything just like yesterday that was done. So I'll be coming back, and we'll be looking into the calculation of this disposal group. And for this disposal group, I have some data available within our Excel sheet, change in group structure, where we will dispose how the disposal of subsidiaries should be accounted for, and how we're going to account it for this thing in an easier way for you guys. So once I'll be back, I'll be giving you the explanation after 5 to 10 minutes. So if there is still any confusion or concern with related to any other aspect of consolidation, you guys must tell me, because today is the last day we are attributing this to the consolidation, and from the next day we'll be looking into the rest of the questions of our section. So I hope it's pretty much clear. We'll be back after like 10 to 15 minutes. Okay. Okay, everyone, let's start and try to make sure we're going to wind it up very quickly. The last requirement before moving to this last requirement, which was how group profit or loss on disposal of bike light should be reported in the consolidated financial statement, and we have to explain it. Before explaining it, we need to make sure what is the how the workings actually done within this data. So I'll be just quickly moving through this disposal of subsidiary. For disposing of a subsidiary, we have to perform the working two that was same done on the acquisition date. We are going to perform the same workings on the disposal date. How this disposal date works, we have to calculate net assets of subsidiary, this column. If you remember from our previous working, I'm just showing you this working. This column 2 relates on the acquisition date or at the reporting date. Data this provides the net assets of subsidiary at reporting date. But once you are disposing of a subsidiary, this column actually relates to the workings related to the disposal date, right? So how to dispose of a subsidiary? So this disposal date always works over here. So this total should be accounted for. You have to calculate net assets of subsidiary at disposal date. Before calculating this one, I'm just making a concept about what items should be accounted for when a disposal of subsidiary should be accounted for. There should be three main workings, or whenever you are acquiring a subsidiary, you are recording three items related to a subsidiary within your consolidated balance sheet or income statement. One thing is your net assets of subsidiary. It means you are adding up all the assets of subsidiary within the assets of parent, and you are adding up all the liabilities of subsidiary within the relevant liabilities of the parent company. So ultimately we have added up net assets of subsidiary within the net assets of a parent. So we have recorded net assets of subsidiary on acquisition. Second thing we have recorded is the goodwill of subsidiary that should be reported in your consolidated statement of financial position data. You can see here, these are the net assets, parent plus subsidiary, and we have recorded goodwill. Third thing, with respect to subsidiary that was recorded in group financial statement or consolidated financial statement, was the non-controlling interest. So we have three items that were recorded upon the acquisition of a subsidiary within the group financial statement. So even on disposal, we have to remove those three things. What these things? One is net assets of subsidiary on disposal date. Second one is goodwill of subsidiary on disposal date, right? And third thing was NCI, non-controlling interest of subsidiary on disposal date. Once these three things are done, we have to make a double entry. I believe I have a double entry working here. If not, then I'll be sharing that double entry. We have the double entry here. So once the working was done, you have to consider you have received the cash on disposal of that subsidiary. The cash you have received should be debited because you have gained the control over the subsidiary within the consolidated financial statements. Second thing, you have disposed of the non-controlling interest, as non-controlling interest is recorded in group accounts in the consolidated balance sheet as a credit entry. So if you want to remove it from your books of account, you must make a debit entry, right? So non-current asset at disposal date should be debited, while net assets of subsidiary are debited in the group accounts in the balance sheet. So if you want to remove the net assets of subsidiary on the disposal date, you have to credit those. Last thing is goodwill. Goodwill is always an asset of the company. So once you are going to dispose of the goodwill, we have to credit it, because on acquisition, this goodwill was debited to the group accounts, and if you're going to dispose of, you have to credit it. Last is this is the balancing figure. I'm mentioning it, balancing figure. This balancing figure will provide you either gain or loss on disposal of a subsidiary. If this balancing figure comes under the debit section on the debit side, then it should be a loss on disposal, and if this balancing figure was reported on the credit side, of a double entry, then it is a gain on disposal of subsidiary. So you can easily identify by making a double entry. I believe within the answer section, examiner has done the same thing. So right now we are going to dispose of the subsidiary in our books of accounts. So I'll be making those workings within our Excel sheet that was over here. So you should be making a double entry, a debit and credit something. So how you're going to debit and credit these items? So you'll be making sure you should be updating cash consideration, how much cash you have received by disposing of this subsidiary backlight. That disposal was provided within the question in last section. On first January, disposal of backlight. Carby sold its entire equity holding in backlight on 30th September 2006 for 150 million. So the cash you have received is 150 million dollars, right? So this is always provided in dollars. So if dollars are provided within the question, then you have to make sure that you're recording this amount in dollars. If it was provided in dinars, then you first have to convert those dinars into dollars to make sure that your gain should be reported in dinars, in dollars rather than dinars. So once you have mentioned the cash, you have to remove NCI at disposal date. And what disposal date? NCI at 30th September 20x6. So what is the value of NCI on 31st December 2006? So we will be looking into NCI value, and I believe we have not calculated this NCI value. We have calculated NCI at acquisition date, and afterwards we have not considered the NCI value. If we're looking into this question, if there is any NCI, this non-controlling interest backlight on 1st January was provided, that was 47.8 million. Right, so any differences that should be reported should be accounted for. So I'll be mentioning here in this question, this should be working one. I'm going to account it for. This working one includes NCI at 1st January 20x6, which is provided in dollar millions. The value of this dollar millions was, NCI value was 47.8 million, right? So you have to share profit or loss share for the year. What was the loss share for the year? So if you're looking into the loss share, this loss for the year was 18.2 million. So you have to consider the loss percentage as you need to, this working should be done over here. So this loss percentage should be reported in 18.2 million multiplied by 20%, right? So this is the loss that should be shared. Along with this, you have to make another adjustment. It's rounded to one decimal place. Loss share for the year. Along with this loss share, you have forex gains on during the year 30th, during the 9 months period 30th September 2000, forex gains on goodwill for the year was, what was this foreign exchange gain loss on goodwill? We have already calculated in, I think, in working one. This is the forex gain loss during the year, during 9 months time period, 8 million multiplied by 20%, because it's a full goodwill method. So I'm going to assign these foreign exchange gain losses arising on goodwill calculation in this section. Along with this, you have to calculate forex gain losses on net assets for the year, right? That's something we have already calculated, and I've shown you that if there is a foreign subsidiary, then this is additional working that you need to perform, and we have already calculated this NCI share along with the working. So I'm going to round this one, and what would be the NCI at disposal date? NCI at 30th September 20x6 would be, this total value is 48.45 something, 48.5. So I have to debit this one, this value, right? Okay, sorry, I believe I did something wrong. 48.5 million. Okay, so this was mentioned over here. Then you have to remove goodwill at disposal date, and we have already calculated goodwill at disposal date. What is the value of goodwill at disposal date? We have to calculate goodwill at disposal date would be goodwill at disposal date. So goodwill at disposal date was 103 million, and what about the rest of things was the another entry that should be accounted for, NCI at disposal date, oh sorry, goodwill at disposal date, then net assets of Bike at disposal date, or I would mention 30th September 20x6. I need to mention the same thing over here, goodwill of goodwill. So I'm mentioning the date along with this to make sure the examiner would understand what I'm doing right now. So the next thing, backlight would be 30th September would be what? Net assets of backlight carrying million at 30 September. Yeah, this is the value, 163.6 million. So this is something a debit and credit was made. Last thing is you have to recycle the foreign exchange gain losses that was reported in profit and loss account to this value. So the value of forex gains that was recorded by the parent, only by the parent, because NCI foreign exchange gain losses are already included within this figure, so we need to include only the parent share. What were those? I believe one is forex losses, this 168, no, this 10.7. I believe if there are any foreign exchange gain losses mentioned within the question, cumulative exchange gain by 1st January, right? 74.1 million, that was always provided within the question. So one thing is it's 74.1 million, 74.1 million multiplied by 80%. This belongs to parent, along with the changes made during the year. One foreign exchange gain loss related to parent is this one during the year, and next one was on goodwill. So the value of the goodwill foreign exchange gain loss will be this value multiplied by 80%. So this is the total of foreign exchange gain losses. Those should be reported in profit and during the disposal in profit and loss account. Those should be recycled to profit and loss account. The balancing figure, how you can calculate the balancing figure? I'm going to total these two sections. This is the total, and along with this is the total. Where you think there is a balancing figure that should be reported, the balancing figure should be reported on, I believe, on the sorry, foreign exchange gain losses should be debited. Why these should be debited? Sorry, control Y, because these are always credit to the profit and loss. This should be reported as a debit figure, because you are going to change the other comprehensive income should be debited with this one. Foreign exchange gain should be debited. And last thing that should be the balance figure, that is gain either or loss on disposal. So gain and loss on disposal should be the balance figure. How we can calculate? As the credit side is higher, so we need to consider this value minus this value minus this value. I believe the total is, sorry, this total should equals this value plus this value minus this value. So the total is, I believe, no, this side is higher and this side is, so adjustment should be made on this side, I believe. This 266 minus 150 minus 48.5 and minus 76.5. So this is minus 8.5. So minus 8.5 is, it's, no, it should be reported on this one side to make sure this both of these two figures get balanced out. So it's gain on disposal. It's gain and loss on disposal. Might be there is some 150 million and 48.5 NCI. This is correctly goodwill. That should be 103 million. Net assets of backlight on 31 is 163.6 million, and forex gains was 76.5 million. So what is the problem then? 274. Okay, fine. This value is higher. Apologies. I was thinking of the credit side was higher. It's the debit side that was higher. So if the debit side was higher, we need to balance this one out. This 274 minus this value and minus this value to make sure this is balanced out. So 8.5 million is the gain that should be reported in disposal of subsidiary. Fine. These are the two sides, debit and credit, that should equal now, and this balancing figure will give you an idea whether it's a gain on disposal. At this adjustment was on the credit side, so we need to make sure that this is the gain on disposal of subsidiary. Any confusion right now till this point? Yes, ratio analysis would be tested. Foreign exchange gains related to what? If you think I want to recalculate foreign exchange gain losses, I'm not sure about. Foreign exchange gain losses, just giving you once again, foreign exchange gain losses, as it's a full goodwill method, so even the foreign exchange gain losses on goodwill should be assigned to parent and NCI both, along with the foreign exchange gain losses on net assets of subsidiaries should be accounted for. And apologies for this is a long session, and unfortunately electricity is not here and it's really hot. Unfortunately this messed up, but this should be something you need to balance out, debit and credit, the total values, right? And this foreign exchange gains, why I have debited, because it was already credited in other comprehensive income, and this foreign exchange gains, these foreign exchange gains are related to a subsidiary which is no more within the group. So you need to remove those foreign gains even from your other components of equity section. So if you want to remove those foreign gains, you have to debit those foreign gains. Are you getting the point? The differentiation why we need to debit this foreign exchange gains, because this foreign exchange gains should be removed from books of accounts, because these foreign exchange gains are related to a subsidiary, and this subsidiary is no more within the group. It was disposed of. So once you are removing those foreign exchange, you have to enter a debit entry. You have to make a debit entry. So which was made in this case, right? Or still there is a confusion? I hope that is clear. Someone is asking for a gain on a goodwill, as it's a full goodwill method, so we will be charging foreign exchange, we'll be charging foreign exchange share to NCI as well. Any question as of now till this point? I'll be looking into how this should be explained. So right now I'm not going to type the explanation, I'm just reading out the explanation, because it might took a lot of time for me to write those explanation down, but explanation would work in the same way as you have calculated the data. So first you need to make your workings for the disposal of subsidiary, and then you will be discussing those explanation. Let me move to the C section. So in this case, first the examiner has explained, but it has not made the double entry. The examiner has just calculated in the same way which was mentioned in this way. As the sample answer was mentioned, most of the students don't understand actually why it was deducted and why something was added. So for that matter, to make a better understanding, I always use a double entry accounting system that give you a better understanding why I am debiting something and why I'm crediting the other amount. So the explanation goes in the same way which was mentioned. Exchange gain loss in first NB as per question was this value which was provided. Current year exchange differences on goodwill is 8.2 million. On the net assets, 13.4 million should be related to the parent and rest is related to the NCI. And foreign exchange gain on therefore 95.7 million. It is giving you the total what we have already calculated. Over here in Excel sheet, we have mentioned that foreign exchange gain losses, those were reported by the company on 1st of January 2006. It is already mentioned within the question, because it's not possible for us to calculate this 74.1, because The data for 4 years was not available. So it's the responsibility of examiner to provide this data to you so that you can make your calculation easily. Next thing is, for the year ended, the 9-month changes, the 9-month foreign exchange gain losses should be bifurcated between NCI and the parent company. I hope this is pretty much clear. If still you have confusion, then do let me know. Yes, it is recycled. Recycled means this gain was reported within the profit and loss account separately. It's not a gain on disposal of subsidiary. These foreign exchange gain losses, once recycled to profit and loss account, that should be reported as a forex gain. Are you getting the point? But it should not be used in the calculation of gain or loss on disposal of subsidiary. Is it clear? Recycling means what? Just give me a second. I think I have that sheet as well. Just give me a second. If I have, then I'll be sharing that sheet with you. It's IS1. If there is any IS1 data available, then okay. This is IS1. So whenever you mean recycling, there is a statement of change in equity. If you are looking into this gain losses, these are the other components of equity, and these are the foreign exchange gain losses. You have seen this 2500. These are the foreign exchange gain losses on operations. First thing, I'm going to look into the revaluation surplus. Revaluation surplus is something that was created on non-current assets, right? IAS 16. If there are foreign exchange gain losses, those are reported. These foreign exchange gain losses should not be recycled. Non-recycling means if there is any gain that is realized, then this gain should be moved directly from this revaluation surplus directly to the retained earning. Suppose I'm just mentioning here revaluation surplus. This I'm just removing 1000 from here. 1000, sorry, it's minus 1000 from here. I'm going to add this one up, 1000 here. This means non-recycling. This data will never appears up within the income statement. Are you getting the point? This data will never appear within the income statement. That should be directly deducted from other components of equity section, and it's moved to the retained earnings section. But if you're looking into this foreign exchange gain losses, this, if there is any fault, suppose I'm making it minus 1500 disposal of a subsidiary. This minus 1500 should now be reported. It is deducted from other components of equity, and it should be reported in your income statement as foreign exchange gain losses. Now I'm reporting this within income statement. This is foreign exchange. If there is foreign exchange gain loss on foreign operation, there it's reported as 1500. Is it clear now? And this 1500 ultimately increase your net profit, right? And this net profit is then moved into the retained earning profit for the year from this section. Are you getting the point of recycling and non-recycling? Is it clear to everyone, or still you have any problem? Sure, I'll be repeating the foreign exchange gain losses. All of you, once again, listen carefully. Foreign exchange gain losses on foreign operation should always be recycled to profit and loss account. I believe that's the question. If the question is different, then I'll be looking back into this working. Foreign exchange gain losses were already reported in your other comprehensive incomes, and only portion of parent is reported in other comprehensive income. NCI was already clubbed in within the value of NCI, right? So this NCI value includes any foreign exchange gain losses. If you have any confusion, I'm showing you once again. Let's see. This is the NCI on 1st of January. This is the loss share, profit and loss account share was total 8 million of loss was reported. Out of that 8 million, I believe 8 million loss was shared. 8 million of the loss was reported by the company, right? 8 million of the loss. Let's coming back to the question, where the question was 8 million loss. I believe 8 million loss was reported. This 8 million dinar loss was reported. Is it clear? So once the 8 million dinar loss was converted, once the 8 million dinar loss was converted into various net assets, once this loss for the year was converted into dollars, that is 18.2 million. If you have a confusion, let's see, 8 million loss, it's for the whole year of pipeline, but the subsidiary was not retained by the parent company, for the whole year. Parent company has retained this subsidiary only for 9 months. So the profit share that can be consolidated in group accounts is only for the 9 months, and in the same way loss should only be shared for the 9 months even, right? So I have taken the loss share for 9 months. Is it done? Then there is an additional depreciation that will enhance the loss. So if you have a confusion in this working, I'm going to remove this one and I'm going to increase the loss. I'm going to increase the loss further by another 1 million, right? Minus 1, or you are going to add it up. I'm going to add this one, and minus sign should be reported out of the brackets. Is it clear now? 8 million loss was reported by the subsidiary on standalone basis, and subsidiary was not in a position to adjust those fair value adjustments. Those fair value adjustments are only made by the parent company, not the subsidiary company. So as the parent has made those fair value adjustment, so it's the parent responsibility to charge the additional depreciation. This 8 million was calculated based on individual financial statement, not based on the consolidated financial statement. So I'm going to add this 1 million additional depreciation, because that depreciation should be charged by the parent based on the fair value adjustment, right? So the total loss for the whole year, if subsidiary will remain with the parent, would become 9 million. Is it clear? So if the total is 9 million, then we have to proportionate it for the 9 months. So the loss associated is 6.75 million. Now is it clear, or still it's confusion? Impairment impact on NCI has not been taken place in working 1. Impairment was already accounted for by the parent company. This examiner has already included the value of impairment. You can see impairment was assigned in the year ended 31st December 2005, while the data provided by the examiner within this question is on 1st of January. So I am always considering it that 47.8 million was already this 47.8 million already include the impairment of goodwill. I hope answered the question. Impairment process. I'm going to discuss the non-recycling means directly go to the returning, while recycling means record in profit and loss account. Yes, record in profit and loss account, and then it moves to the retained earning. It does not require so much workings. This 3 marks is something, because most of the working was already done in rest of the sections, above sections. So you need to link those workings with the disposal section. Is it clear, or still someone has confusion related to this disposal? Anyone? I believe I have no further question. If still you have any question, do let me know. And now I'm going to end the session. If there are any questions, we'll be coming back. We'll be discussing those questions in the start of the section. So do you share? Reading conceptual framework 2018 technical article is, yes, I believe it's enough. It's enough. But along with the technical article, you need to read the conceptual framework document as well. If you need, I'll be sharing that conceptual framework document tomorrow with you all, and I'll be sharing that document with you. I believe this document was available for everyone. If I have the link, then I'm going to share that link with you all. Just give me a second. Conceptual framework. Yeah, this is the conceptual framework project summary. So if you need, I'll be sharing this document with all of you. This is a conceptual framework 2018 document. It was provided by IFRS. So that is a document of almost 20 pages. These are just a summary document, so you can read out this document to make sure what are the changes made to the whole framework document. So there are few of the adjustments. You can go through this document. You'll understand what is the impact of revised framework and how the revised framework actually works. I'll be sharing this document tomorrow with you guys within that section. And one more thing, please read out. Summarize what? No, IFRS 9 is very important. So don't consider, I'm not sure whether the examiner is going to ask a question related to IFRS 9, but IFRS 9 is pretty easy. It's not a difficult one. It's the easiest standard, except derivatives. Derivative section is the only section that seems to be difficult one, but rest of the standard is pretty easy. I don't understand. Summarize it for us and keep discussing on it, please. I don't understand what this question actually means. So if there is no further question, do let me know. I'll be if you got time, then most probably I'll be discussing IFRS 9. But before this, I'll be moving to other aspects. If you need, I'll be discussing IFRS 9, but I'll be discussing that at the very end. For sure, I'll be discussing few of the standard with you guys tomorrow with respect to aspects which I think could be accessible, but that guess doesn't mean that the data should always be appearing within the exam. So most of the time, I'll never suggest any individual to go with what should I say, to go with some selective study. I always recommend everyone to go through the whole syllabus, because after getting qualified from ACCA, when you go into the practical life, you have to have a knowledge of all the standards. IFRS 15 and IFRS 5 also, there are a lot many standards you guys are discussing. So I'll be okay. Thank you so very much, guys, everyone, and you need to understand rather to memorize it. I would recommend you need to understand the logic of standards. Once you understand the logic of standard, you will never need to apply those standards within. We will never need to learn those standards. In short, I would say you need to understand the concept behind what was the actual theme behind and how this standard would be working. So that's really important. Thank you so very much, everyone, and I'm going to end the session. Tomorrow we're going to start the session. If you guys have any question, do let me know. I'll be answering it, and for sure I'll be sharing this conceptual framework document with you guys tomorrow, so you can download that document. And I believe we have next session would be related to question number 2, 3, and 4 we have left with, and we have one question for all of these sections. So we'll be looking into those questions tomorrow. Okay, everyone, thanks. Bye. I'll try to share the summary of IFRS with you guys, but that would be tomorrow or some other day. Thank you so very much, everyone. Bye.